Welcome back to Factful Finance, where we transform complex financial topics into actionable knowledge. Let's dive into a concept that plays a critical role in shaping economies and affecting your financial strategy: inflation and deflation. These two forces are often seen as opposites, but they're intricately connected, and understanding how they interact can help you make smarter financial decisions. So here's a question: what happens when inflation gets out of control, or when deflation takes hold? And what can we learn about these forces to better prepare for the future? Today, we're going to uncover how inflation and deflation work together in the financial ecosystem, the impact they have on your money, and the strategies you can adopt to protect your wealth. Let's start by breaking down the core concepts. Inflation, at its core, is when the general price level of goods and services rises over time. This means that, over time, the purchasing power of your money decreases. You might have noticed that a gallon of milk today costs more than it did a few years ago. That's inflation in action. On the other hand, deflation is the opposite. It occurs when the general price level falls. At first, this might sound like a good thing. Who doesn't want lower prices? But deflation can lead to reduced demand, falling wages, and overall economic stagnation, which can be just as damaging, if not more so, than inflation. Here's where the relationship gets interesting. Inflation and deflation can influence each other in complex ways. For example, when inflation is high, central banks typically raise interest rates to cool the economy down. But if inflation falls too low, there's a risk of entering a deflationary cycle, where consumers and businesses delay spending in hopes of even lower prices, which then causes the economy to contract further. It's a delicate balance. Now let's look at how this plays out in real life. Take the 2008 financial crisis, for instance. In the aftermath, we saw the U.S. economy teeter on the edge of deflation. Prices were dropping, unemployment soared, and the Federal Reserve had to step in with aggressive monetary policies like lowering interest rates and increasing the money supply to keep the economy from falling into a deflationary spiral. But here's the twist: inflation didn't stay low for long. The economic recovery led to rising prices, and soon enough, inflation started creeping up again. Central banks had to manage both the risks of deflation and inflation to avoid an economic disaster. Let's bring it down to a more personal level. Imagine you're like Sophie, a small business owner. During a period of inflation, you notice that the cost of materials to make your products is rising. Your customers are still willing to pay, but your profit margins are getting thinner. On the flip side, if deflation sets in, your customers might wait longer to buy from you, hoping prices will fall even more. Both situations create unique challenges that need different strategies. Here's a quick tip. To protect yourself against inflation, think about investing in assets that tend to outperform during inflationary periods, such as stocks or real estate. On the flip side, in a deflationary environment, cash and bonds can be more valuable as prices fall. So whether it's inflation or deflation, the key takeaway here is that both forces are tied to one another. Managing them requires a balanced approach, keeping an eye on economic signals and adjusting your financial strategies accordingly. If you're wondering what role the government plays in all this, the answer is crucial. Through fiscal and monetary policy, governments and central banks regulate inflation and deflation. For example, the Federal Reserve's control over interest rates directly affects inflation, but their actions can have unintended side effects, pushing the economy into one direction or the other. So, what can you do with this knowledge? In times of inflation, diversify your investments to hedge against rising prices. In deflationary periods, focus on preserving your capital, looking for opportunities where prices have become more attractive, but be cautious not to overextend. Now let me ask you this. Are you prepared for the next shift in inflation or deflation? Have you taken steps to protect your wealth? Let me know in the comments. I'd love to hear your thoughts. And if you found today's deep dive helpful, hit like, subscribe for more insights, and don't forget to turn on the notification bell. You won't want to miss what's coming next. Remember, this content is for educational purposes only. I encourage you to consult with a certified financial professional for personalized guidance. Want to take your financial knowledge to the next level? Keep watching for more tips on navigating the economy and optimizing your financial strategy.